Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Moog Inc. quarterly report. Moog Inc. offers a diverse range of businesses and services across various industries. At its core, the company designs, manufactures, and integrates precision motion and fluid controls and control systems for original equipment manufacturers and end users. The company operates through four main segments: space and defense, military aircraft, commercial aircraft, and industrial. The space and defense segment provides critical defense components and motion control systems used in various applications such as defense vehicle platforms, missile systems, naval ships, and submarines. This segment also caters to the space industry with high-performance components and systems for launch vehicles, satellites, and spacecraft. The military aircraft segment designs, manufactures, and integrates primary and secondary flight controls, mission-critical actuation systems, and products for various military fixed-wing aircraft and rotorcraft. The commercial aircraft segment offers flight-critical control systems and products for commercial aircraft, including widebody, narrowbody, business jets, and regional jets. The industrial segment provides customized and high-performance motion control components and systems for industrial automation, medical, simulation, and test, and energy applications. This includes precision components used in heavy machinery, medical devices, power generation products, as well as simulation platforms for flight training and material testing applications. Overall, Moog Inc.'s diverse range of businesses and services cater to various industries, including aerospace, defense, and industrial markets. Moog Inc.'s stock price has skyrocketed by approximately 50–70% over the past year due to a combination of strong financial performance, increased demand across its key segments, and positive market outlooks. The company's record fiscal Q1 2026 results, with sales increasing by 21% to $1.1 billion and diluted net earnings per share rising by 38%, were a significant contributor to this growth. Moog's broad-based demand across all major operating segments has also played a crucial role in its stock price surge. The space and defense segment saw a 31% increase in sales, driven by robust demand for missile controls and satellite components. The commercial aircraft segment experienced a 23% rise in sales, fueled by higher volumes in major production programs and increased aftermarket activity. The company's record backlog of $3.3 billion, which expanded by 30%, indicates sustained demand across all its markets and secures future growth. Moog's consistent earnings surprises, with the company exceeding analysts' consensus estimates for EPS in 4 consecutive quarters, have also contributed to investor confidence. Furthermore, Moog is recognized as a key beneficiary of the growing commercial and defense aerospace markets, which are projected to expand significantly. The company's operational efficiency initiatives, including facility consolidation and simplification programs, have led to improved productivity and stronger margins. Overall, Moog Inc.'s strong financial performance, increased demand across its segments, and positive market outlooks have driven its stock price surge over the past year. Moog Inc. maintains a market capitalization of $10 billion, broadly in line with the industry peer group. Moog Inc. trades at a higher price-to-earnings ratio of 40 times, and a higher price-to-book ratio of 4.94 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. The space and defense segment has seen a significant surge in revenue, with a 49.4% increase from 2024 to 2026. This is closely followed by the military aircraft segment, which has experienced a 19.3% growth over the same period. Additionally, the commercial aircraft and industrial segments have also shown notable increases of 10.2% and 42.5%, respectively. Other drivers of revenue growth include U.S. government contracts, repair and overhaul arrangements, large commercial contracts, organic expansion of high-performance components business, acquisitions, pricing strategy to recognize value delivered to customers, simplification initiatives, manufacturing and operating efficiencies, and higher orders in various segments. Furthermore, the company's increased 12-month backlog has also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are primarily related to gross margin decrease and interest expense increase. The decrease in gross margin is attributed to higher tariffs in the commercial aircraft and industrial segments. Additionally, an increase in interest expense due to higher outstanding debt balances, partially offset by lower interest rates, has also contributed to revenue decline. The analysis of net income and profit margins reveals a mixed picture over the two-year period from Q4 2024 to Q4 2026. On one hand, the overall net income increased by $21,325, 37%, indicating a positive trend in revenue generation. However, this growth was not uniform across all segments. The gross profit margin decreased by 0.4% from 27.1% to 26.7%, suggesting that while companies were able to increase their revenues, they struggled to maintain their pricing power and efficiency in production. On the other hand, operating profit margins showed a more encouraging trend, increasing by 2.8% from 14.5% to 17.3%. Segment-wise analysis reveals some interesting insights. The space and defense segment saw a significant increase in net income of $14 million, 49%, but this was accompanied by a decline in profit margin from 13.2% to 11.6%. In contrast, the military aircraft segment experienced a modest increase in net income, with a slight decrease in profit margin from 11.4% to 11.1%. The commercial aircraft segment reported a decrease in net income, despite an operating profit of $28 million compared to $26 million. This was accompanied by a decline in profit margin from 10.6% to 11.8%. Finally, the industrial segment saw a notable increase in net income of $11 million, 44%, along with an increase in profit margin from 13.9% to 14.2%. Overall, while there are some positive trends in terms of revenue growth and operating profit margins, the decline in gross profit margins and mixed performance across segments suggests that companies need to focus on improving their pricing power and operational efficiency to sustain long-term profitability. The company's financial performance indicates a positive trend in operating cash flow. A comparison between the years 2025 and 2026 shows an increase in operating cash flow, with $73,359 generated in 2026 compared to $62,013 in 2025. This growth is further highlighted by the net operating cash flow of $154,495 for 2026, which takes into account proceeds from collections. The increase in net contract assets primarily reflects unbilled revenues, suggesting that the company's revenue recognition process is aligned with its cash inflows. Overall, these figures indicate a strong ability to generate positive operating cash flow, demonstrating the company's financial stability and growth potential. The company's financial health has undergone significant changes over time. A notable trend observed is an increase in long-term debt, which has risen from $944,123,000 to $1,052,312,000. This substantial growth indicates a considerable escalation in the company's debt obligations. Furthermore, total liabilities have also seen an upward trajectory, increasing from $2,433,500 to $2,486,093,000. While this increase may not be as pronounced as that of long-term debt, it still signifies a rise in the company's overall financial commitments. In terms of interest expenses, there has been a slight but noticeable increase of plus 5.8% and plus 6%. Although these increments are relatively modest, they do suggest an upward trend in the company's interest payments. Overall, the data suggests that the company's debt level and interest expenses have increased significantly over time, with no clear indication of a substantial decrease. Management is optimistic about the company's outlook, citing several key points that support their confidence. In the short term, they expect to recognize approximately 45% of remaining performance obligations as sales over the next 12 months, indicating a strong revenue stream in the near future. Additionally, management has stated that they have sufficient funding to meet cash requirements for at least the next 12 months and beyond. Looking ahead, management believes the company is well positioned for long-term growth due to its core capabilities and technologies. They aim to embed these technologies within high-performance military programs of the future, which will drive revenue and expand their market share. Furthermore, they expect attractive aftermarket sales and service opportunities from their large installed base of products. The aerospace and defense market is also expected to grow, driven by increasing demand for technologically advanced products and rising defense funding levels. The space market is anticipated to experience significant growth due to increased investment in exploration activities, government-authorized defense spending, and demand for small satellites. In terms of financial strategy, management plans to continue exploring strategic acquisitions and returning capital to shareholders through quarterly cash dividends. They have also authorized a share repurchase program to buy up to 3 million common shares. Overall, these statements suggest that management is confident in the company's ability to drive growth and deliver value to shareholders. The company's financial history reveals a consistent commitment to returning value to its shareholders. One of the key ways it has achieved this is through dividend payments. The records show that the company has paid dividends on multiple occasions, as noted in various pages of the extracted summaries. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share for existing shareholders. The summaries indicate that the company has bought back shares on several instances, further demonstrating its focus on shareholder value creation. There are concerns about inventory buildup and potential disruptions to the supply chain. Recent data shows that inventory levels have increased significantly, with raw materials rising by $10,193 and finished goods increasing by $1,227. This surge in inventory may be attributed to various factors, including supply chain constraints affecting major players like Boeing and Airbus. The production rates of these companies are being impacted due to supply chain issues, which could potentially affect demand for their flight control systems. Furthermore, the company's own cautionary statement highlights supply chain constraints as a potential risk factor. This suggests that the management is aware of the risks associated with supply chain disruptions and is taking steps to mitigate them. However, the increasing inventory levels and supply chain constraints do raise concerns about the company's ability to meet demand in the future. That concludes the financial summary for Moog Inc. Feel free to comment below, and I will be happy to answer them when possible.